Hey James, it's Leonard, the Poker Paparazzi again, and I actually wanted to follow up with regards to the Wealth Care Wednesday topic, which is how you personally leverage your wealth building blocks. For example, if you wanted to invest money in the stock market with companies such as Amazon, Tesla, and so forth, how would you break down the income passing through into, let's say, your infinite banking, your dynamic banking, your life insurance policies? Can you kind of walk us through, I guess, the step-by-step cycle of how that money could make it into the stock market and then back out into your personal dynamic banking type situation? Yeah, I'd love to hear more about your personal insight about that. Thanks.
All right. I love the question. You want to know how do I move my money around, right? Now you ask for step by step. I don't really have a step by step. What would you call it? Template necessarily. But what this boils down to, and I kind of go over this in my last video that I put up called Revisiting Wealth Building Blocks. When we consider personal wealth building blocks, if you don't know what I'm talking about, check out the Wealth Building Blocks videos. What I do is I go through specifically and identify how to take regular expenses that you would normally have and how to turn each regular expense into a personal wealth building block. Something that is currently just a regular expense. You might have car payments, house payments, utility bills. It really could be any expense, taxes, property taxes that you pay. Anything that you pay regularly that you might normally just get paid, put that money aside, or have it sit in your checking account until payday comes around, and then you make that payment. So that's kind of like the typical way that money gets moved for your average person. Okay. What I do and what the wealth building blocks is it says you actually have the ability to take that expense that you normally have, divert those funds into your infinite bank, and we use an infinite bank specifically, which is high cash value whole life insurance, or you can do it with an index universal life policy. But for the most part, we're talking about whole life policies that are specially designed for high cash value. You can divert an expense into that policy and then bring it back out again to pay the bill. And that does two things for you. It helps you to increase your premiums in that policy. So trying to get up to there's a maximum amount that we can put into those policies every single year, and we want to hit that max every single year. So this helps us get to that point. But I also in those videos go over how you can take each one and what it does when you do that so that it creates wealth for you. You take an expense that you normally have and you create wealth just by moving your money in a different way. Now, I do that as an example, okay? In the last video I put up, Revisiting Wealth Building Blocks, I kind of go over how I do stuff, which is I don't actually, it's sort of like using it as a checking account, but not really, because it takes a little bit longer to get it. It takes a little bit longer to get it than would a checking account. Where was I at? But in that video, I basically go over how those individual wealth building blocks are just ideas. The main thing to understand is how we move money matters. And ideally, we want to make every dollar that flows through our hands work for us the most that it can. So when we get money into our hands, when we get income, when we get paid, when we sell something and we just have cash, regardless of what it is, you have three choices with that. You can invest it, You can save it or you can spend it. And traditionally, you cannot do more than one of those things. If you're saving it, you're not investing it and you're not spending it. If you spend it, that money's gone. You can't do the other two things. And if you're investing it, it's tied up in the investment, which negates the ability to spend it another way unless you get out of that investment. And it doesn't count as savings either, because it's generally not considered safe enough to be considered savings, right? Or it may not even be liquid. It may not be liquid to be able to use. Our infinite banks are designed, they're guaranteed when we use a high cash value whole life policy. You're guaranteed growth in those policies by contract. You're guaranteed access to that cash by contract. You can borrow against that policy and you have access to those funds, typically up to 95% of the cash value at any given time. Because of the guaranteed growth, we have what we call break-even period, where you're going to have more money available in that policy than you've paid into it. And we try and get that break-even period to be within about 4 or 5 years. So that's considered your ramp-up period. But it's important that based on the design that we have as much cash available in those first few years also. So we try and design it to get 90 to 95% cash value available in year one. So you have the ability to funnel your cash, what goes to a normal expense, you have the ability to funnel that into that policy to help maximize it. When you borrow against the policy, the insurance company gets the interest. You got to check out my videos. Yes, Top Gun, whole life insurance is the bedrock of sound wealth creation. Top Gun's been practicing this, I believe, or at least he's about to get into it. He's been doing a ton of research on it. But the insurance company gets the interest, but the key is that they also credit your policy, and your policy can be credited with the same amount of what you're borrowing or even more than what you're borrowing. And that's the key to these things. So if you find my videos called Infinite Banking, I have an Infinite Banking Explained. I have an Infinite Banking for business owners. Business owners can really make this thing take off. It's really, I wish I knew about this back when I had my business. I had a business for 13 years. No idea how to maximize the use of the money that came through my hands as a business owner. It would have been a game changer for me. So anyways, what this boils down to is, what do you do with your dollars? And for me, so specifically the question was, what's my roadmap? How do I move the money so that I could use it and buy some Tesla with it? Because that's what I just did. That's what I did with it, right? What I do, I wake up each day. So I do something called dynamic banking and infinite banking, and I kind of put them together. Hey, Robert. I work with those together, and I urge you to check out my videos if you haven't seen the videos on either of those. Dynamic banking is more about a mindset on how to move your money to maximize your cash flow. Infinite banking is a product. It's something, or it's more of a process, but it's something we do inside of life insurance policy. Dynamic banking we do with lines of credit. You can also do it with a life insurance policy, but it doesn't work as efficiently because it takes more time to put money in and take it out. So ideally, what I urge all my viewers to do, if you want to maximize your cash flow, get a line of credit and do an infinite banking policy. With those two things together, what I personally do, I wake up and I get used to, first thing I do is I get used to any income that comes into my hands, I put it in the line of credit right away. I'm always using the line of credit at least a little bit, whether I'm paying down a debt or whether I'm putting it into a growth product, like my life insurance policies. Okay, so that's the first thing. I always have a small balance at the very least that I can offset every time I get some income. And I take those small balances that I use, those chunks, and I put them to work. I either put them to work paying down debt with dynamic banking. So I might put a chunk of it towards, you can put a chunk towards your mortgage. You can put a chunk towards car payments. You can put a chunk into your life insurance policy. You can put a chunk into the stock market. There's all kinds of things that you can do with it, but we always want to be using some of someone else's money so that when our money comes in, we can offset it, but we've already started that growth process with the chunk. Okay? So it comes to waking up. When I wake up each day, I look at where my money's sitting and I think, is it in the place I need it to be? And if it's not, I move it. So I don't necessarily lay out each individual wealth building block. Okay? I'm not that detailed when it comes to moving that money. I just know when I wake up, I'm going to move my money to where it's going to do the most for me. So the other day, last month, I was like, I'm going to check out this Tesla stock. And I was like, wow, this is moving. I'm a believer in the stock. I haven't really done much in the stock market except for play around a little bit. But I thought, you know what? If I pull some money out of my infinite bank, I'm going to pay, depends on the policy I move it out of, but it's going to cost me basically 4.5% to 6% interest. Can I do better than that in the stock market with those funds? With Tesla specifically, not just with anything, but because at the time I wasn't doing any day trading. Didn't have enough money in there. I could just basically do some trades each day. If I wanted to buy and sell the same stock, I have to wait a day. So my thinking was, yeah, I probably could. Yeah, now I'm hooked. So my thought was, yeah, I probably could. So I did that. I moved the money in. I bought some Tesla stock. And then there was hype about the S&P 500 inclusion. And there was hype about, well, we didn't even really know about a possible split at this point. I basically bought in because of that S&P 500 inclusion. I was like, oh, it's definitely going to go up when that hits. I want to take advantage of that. So moved some money into my checking account, moved it from there into my stock account. Each day, that's what I do. I just look at my accounts and I think, where's the best use of those funds? I don't worry about if it's a loan out of my policy, if it's a loan out of my home equity line of credit. I'm always moving money to wherever I have the lowest amount of interest that I'm paying. And as long as I'm using it to maximize my return on it, I'm pretty happy. So long answer short, I just move the money to where I think it's going to do me the most good. Now, to get it from my insurance policy to my account to do Tesla, because I don't have a HELOC right now, because I just refinanced my house, I have a bunch more money sitting in my checking account than I normally would. So I don't have a line of credit that I can be using to offset. So my infinite banking policy is where all my income goes, okay? Except I'm sitting on quite a bit of it in there right now, because I got a lot of things that I'm expecting to come out. I'm starting a couple of new policies, so I want to have enough money to pull that out, and I don't want to have to wait for it. It takes a couple of days to get the money out of a policy, and it takes a couple of days to put money back into the policy. I've already hit the MEC limit on all my policies for this year. So anything I start, I've already hit the MEC limit. So I've got loans out of them for when I used them. I can't put any more new money into them this year. Okay, so for me, that's simple. If I had room available, I always try and hit that MEC limit first. For people who don't know, MEC is modified endowment contract. And you do not want to turn your insurance policy into a modified endowment contract because you lose out on all the tax benefits except for the tax-free death benefit. That's still there, but if it becomes a modified endowment contract, when you pull money out, it's just, or when you borrow against it, it's just like you're pulling money out, and they're going to charge you taxes on it as if it's income. So we don't want that to happen. What we do want to do is keep it right up really close to that MEC limit, because that is the most efficient use of our dollars. And as soon as we put money into those policies, it's going to compound for the rest of our life, guaranteed by contract. And we do that with mutual companies. We become an owner of that company. So we end up wanting to do that with really strong companies that have 150 plus years of paying dividends, because we get a guaranteed growth of 4%, but we get the dividends above and beyond that. If the dividends are above 4%, we're going to get whatever the dividend rate is. If the dividends are below 4%, we're going to get that 4% guarantee. So that's why we use those. It is not the most efficient vehicle for getting money in and out of very quickly. So it's like it's like our second tier. It's a great place for storing emergency money, emergency funds. It's a great place for an emergency fund. It's also a great place for capital expenses. We have a lot of real estate investors that get these policies, and that's where they keep their capital funds. You keep it in there, it does a lot for you. One, it helps to grow your death benefit. Two, if something were to happen to you, your properties can get paid off. And three, you get guaranteed growth. You don't have to keep it in a low interest bearing savings account or checking account. We always try and get these dollars to do multiple work for us. So hopefully that answered your question. The main thing I try to get across to folks when you want to know about how to move money is just don't worry about the source of it necessarily. Yeah, when you pull it out of your policy, it's going to be a loan. But remember, we always have a cost of using money. We're either gaining interest or we're paying interest. When we use our infinite bank, we're going to do both. So we're going to pay interest, but we also get credit. So it's always compounding. Okay, that was a long-winded answer. Hopefully I covered everything. Like I said, the main thing is you want to get used to moving money efficiently. And I think that comes more with mindset than with figuring out the exact dollar of each wealth building block. A lot of people that watch this channel are like engineer types or accountant types that love the detail that I provide in my videos. I put a bunch of spreadsheets up so you can see exactly what those dollars are doing, but you don't want to get stuck in the minutia of trying to figure every little thing out. I put the details up there so that you don't have to worry about those details. You just know if you get the money into your policy, you're going to be better off. That's the bottom line. If you want to get in and keep track of those details yourself, you're more than welcome to. But not everybody likes to do that, or you may already be doing that with plenty of other things in your life. So I'm not trying to add more complexity to how you do this. It's actually pretty simple. As soon as you get used to the concept of money comes into your hands, goes in to offset some interest somewhere. And in this case, the interest that you're going to offset is either in the line of credit or it's in your infinite banking policy. This was a question asked and answered during one of our Wealth Care Wednesdays live streams. If you have any questions, leave them in the comments section below, or join us on one of our Wealth Care Wednesday live streams where you can ask the question and we'll answer it on the air live. I hope you found value in today's video. If you'd like to find out more about IUL and whole life, check out these videos right over here, and we'll see you next time. Now go maximize your cash flow.